Even for those of us who feel pretty comfortable managing our money, um, big financial decisions can sometimes throw surprises at
Oh,
us.
absolutely.
Like thinking about financing a new car, maybe, or needing funding that's, well, outside what traditional banks offer.
Yeah, it can get overwhelming fast. There's just so much information out there.
Right. So today, we really want to cut through that noise, give you the knowledge, the confidence to make genuinely smarter choices.
That's exactly the mission for this deep dive. We've looked at some really insightful material,
Hmm.
and we're going to unpack three key things. First, this slightly confusing term, AL finance.
Okay.
Then, why the annual percentage rate, the APR, is like your best friend for comparing loans.
Super important.
And finally, why having an emergency fund isn't just nice. It's absolutely essential.
Yeah, and understanding these isn't just, learning jargon. It's about how this stuff really impacts your borrowing costs, your financial security.
Your peace of mind, really.
Exactly. It puts you in control. So let's circle back to that idea, maybe buying a car. You're looking for wheels, but you're also stepping into this world of AL finance.
Mhm.
And our sources say this term, it's a bit tricky, isn't it?
It really is. AL finance actually covers two pretty different areas. First, there's auto loan finance.
Right.
That's the specialized financing just for buying vehicles. Think dealerships, specific auto lenders, that kind of thing.
Okay. The direct path to getting the car makes sense.
But then AL also stands for alternative lending finance.
Ah.
And that's basically, well, everything outside the traditional banking system.
So online lenders, peer-to-peer.
Exactly, P2P lending. Also things like crowdfunding loans and, buy now, pay later, BNPL, which is everywhere now.
Okay, so two distinct meanings. Let's maybe tackle the auto loan part first. Our sources had some interesting angles there.
Sure. So how does it typically work? And maybe more importantly, what are the strategic upsides?
Yeah, let's start there.
Well, the process itself is usually pretty straightforward. You apply, maybe at the dealership, maybe with a lender directly.
Okay.
They look at your credit, your income, the car's value,
Mm.
the usual stuff.
Mm-hmm.
And based on that, they set the terms. Your APR, how long you have to repay, the monthly payment,
And the money goes to the seller.
usually, yeah, directly to the seller if approved.
So the obvious benefits are, getting the car faster, having a clear payment plan.
Right.
But you mentioned something about its role with credit that caught my eye.
Yes. This is really important
Hmm.
and often missed. Auto loans aren't just for people with perfect credit.
Okay.
Our research highlights that it often includes subprime options. So think about someone with a, let's say, less than perfect credit history.
Yeah.
If they manage that auto loan well, make payments on time, consistently, it can actually be a strategic tool to rebuild their credit score.
Wow. Okay. So it's not just a last resort.
Not at all. It can be a proactive step towards improving your financial standing.
That completely reframes it. A pathway, not just a purchase. Okay, so what about the other AL finance? The alternative lending side.
Right, so this is a much broader category. You've got the online platforms, P2P as we mentioned,
Mm.
even things like crowdfunding, where lots of individuals might chip in for one loan.
Interesting. And who's the typical user here? Who does this serve?
It often serves people and small businesses too who might hit roadblocks with traditional banks.
Like maybe limited credit history or needing money faster.
Exactly. Maybe their credit history is thin or unconventional, or, yeah, they just need the funds much quicker than a big bank can move.
So the big draw is easier approval, faster cash.
Generally, yes.
Yeah.
Easier approval and quicker turnaround times are definitely hallmarks.
Is there a catch? Like higher rates, maybe?
Sometimes, yes. The trade-off can be higher interest rates or different fee structures because the lender might see it as higher risk.
Makes sense.
But the real insight, I think, is how alternative lending offers tailored solutions. It's great for freelancers, gig workers, small businesses.
Ah, people who don't fit the standard bank box.
Precisely. Anyone whose income or situation doesn't neatly align with traditional underwriting. It's really opening up access to capital.
That's a key difference. Empowering people with transparency. It's amazing how one term covers such different worlds.
It is.
But despite the differences, our sources mention some common ground that actually makes things easier for borrowers, right?
They did, yes. Both auto and alternative lenders are increasingly using technology. So you see online applications everywhere now. Super convenient.
Yeah, that makes sense.
And crucially, Many offer pre-qualification tools.
Oh, that's huge.
It really is. You can check your potential eligibility, see possible rates, without getting a hard inquiry on your credit report.
That lowers the barrier to just shopping around.
Definitely. Plus, many provide credit score education resources. They might offer lower down payment options, more flexible repayment plans.
So it's all about making lending more accessible.
I think so. More accessible, more transparent, trying to empower you, the borrower, to navigate these options better.
Okay, so with all these options, auto, alternative, different lenders, how do you actually compare offers effectively? What's the one number that cuts through the marketing noise?
Ah, yes. That brings us squarely to the APR, the annual percentage rate.
The magic number.
If you master one thing when borrowing, master this. Lots of people think they get it, but there's a key detail often missed.
Which is?
It's not just the interest rate. It's the total yearly cost of the loan, shown as a percentage.
Total cost. So it includes more than just the interest.
Yes, exactly. That's the power of it. APR bundles the interest plus most fees tied to the loan.
Like origination fees,
Yeah.
processing fees,
Yeah.
kind of stuff.
Origination, processing, administrative costs, most of those upfront charges. And this isn't just lenders being nice. No, it's often required by regulations like the Truth in Lending Act in the U.S. It's designed specifically to standardize comparisons.
Ah, so it forces an apples-to-apples comparison, even if lenders structure fees differently.
That's the idea. Let's take a quick example. Say a $10,000 loan. Offer a, quotes, a 6% interest rate. Sounds okay, but maybe it has $500 in fees rolled in.
Right.
The APR reflecting that total cost might actually be 6.5% or even higher. That 0.5% difference adds up over time.
Wow. Especially on bigger loans or longer terms.
Absolutely. And think about credit cards. They
Yeah.
often have lots of little fees.
Yeah.
The APR tries to capture those too, giving you one number to compare.
So it shows the real cost. The bottom line is always compare APR.
Always. Whether it's a car loan, personal loan, credit card, look at the APR.
Is there like a quick smell test, a warning sign if an APR seems way off?
Definitely. If an offer's APR is dramatically higher than the average for that type of loan, especially considering your credit profile, big red flag.
What could that mean?
It could mean really high fees, maybe even predatory ones. Or it could mean the lender sees you as very high risk.
And what if it looks too good?
Also a warning sign.
Hmm?
That might be an introductory rate that jumps up later. You need to dig deeper.
Right, which leads us perfectly into the different types of APR, because they're not all the same, are they?
Not at all. And getting tripped up here can be costly. First, you have fixed APR.
Simple enough, stays the same.
Stays the same for the whole loan term. Predictable payments, easy to budget for.
Okay.
Then you have variable APR. This one, well, it can change. It goes up or down.
How does that work?
It's usually tied to a benchmark index, like the prime rate. So if the prime rate goes up, your APR likely goes up too.
Less predictable then.
Much less.
Uh.
You really need to look at the caps. Is there a maximum rate it can hit? And understand the index it follows. Small changes can really impact your payment.
Yeah, credit cards often have variable rates, right? What's the biggest trap there?
With variable rates, probably ignoring the potential maximum rate, people focus on the current rate but forget how high it could climb if the index spikes.
Good point. Okay, what else?
Then there are introductory APRs.
Yeah.
You know, the tempting 0% or super low rate for, say, the first 6 or 12 months.
The hook?
Exactly. The obvious trap is forgetting when that period ends.
Yeah.
Because the rate that kicks in afterwards is usually much, much higher.
Need to mark that date on the calendar. Big red circle.
Absolutely. And finally, the one you really want to avoid, penalty APR.
Oof. Sounds bad.
It is. If you miss payments or violate terms, the lender can jack up your rate significantly. It really hurts.
Okay, so knowing these types is vital. Now, for you, listening, wanting the best possible APR, what are the key strategies?
Number one, without a doubt, your credit score.
A big one.
It's the single biggest factor, improving your score consistently. That opens doors to much lower rates. Focus there first.
Okay, what else?
Second, shop around meticulously. Don't just grab the first offer. Compare banks, credit unions, online lenders, get quotes.
Use that competition.
Yes. Third, read everything. Understand all the loan terms before you sign. The fine print matters. And finally, don't be afraid to negotiate, especially on fees. Sometimes there's wiggle room if you ask.
Great advice. Improve credit. Shop hard, read carefully, try to negotiate. But where do people commonly stumble with APR, even if they know the basics?
Good question. A big pitfall is focusing only on that low introductory APR.
Right, the shiny object.
Yeah, and then getting hit with sticker shock when the real rate kicks in later. It happens all the time.
Okay, what's another one?
Not realizing that some fees might not be in the APR calculation.
Wait, I thought it bundled fees.
It bundles most upfront fees related to getting the loan. But things like late payment fees or penalties for paying the loan off early, those might be separate.
So you still need to check the entire fee schedule.
Absolutely. The APR gives you the cost of acquiring the credit, but not necessarily penalties for how you manage it later.
Got it. Anything else?
Yeah, one more common misconception. Assuming the lowest APR always means the lowest total cost over the whole loan.
How could that not be true?
Loan term makes a huge difference. A slightly lower APR on a 30-year mortgage will likely cost you far more in total interest than a slightly higher APR on a 15-year mortgage.
Because you're paying interest for twice as long.
Exactly. So you have to consider the APR and the loan length together to understand the true overall expense.
Makes perfect sense. So APR is the starting point, the best comparison tool for the initial cost.
But not the only factor for total cost.
Yeah.
It's your best tool for transparency, though. Seeing behind the curtain.
Empowering you to borrow smarter, absolutely.
Whether it's for that car or something else entirely.
Okay, so we've talked a lot about borrowing wisely, but what about, avoiding borrowing, especially expensive borrowing, when life throws those curveballs?
Mm-hmm.
That leads us straight to the emergency fund, doesn't it?
Yes. The emergency fund. I honestly think of it as a financial superpower.
A superpower. Okay, tell me more.
It's not just any savings account. It's a specific pot of money, kept separate, and it's only for unexpected, truly necessary expenses.
So we're talking real emergencies, not like wanting a new TV.
Definitely not. Think major stuff.
Right.
Losing your job suddenly, a big medical bill that insurance doesn't fully cover, your car dying and needing immediate costly repairs.
Or your furnace breaking in winter.
Exactly. The kind of thing that can just financially floor you if you're unprepared.
It's the safety net, catches you when you fall. So why is it so critical you called it a superpower?
Well, think about it. First, job loss protection. If your income vanishes, that fund lets you pay rent, buy food, keep the lights on.
Buys you time.
Crucial time. Time to find new work without utter panic. It reduces that immense pressure.
Huge stress reliever right there.
Massive.
Yeah.
Second, it helps you avoid debt. When a crisis hits, what do people often do?
Reach for the credit card, get a high-interest loan.
Exactly, which makes the problem worse long-term. With an emergency fund, you use your own cash. It's so much cheaper.
Way cheaper. Avoids that debt spiral.
Definitely. And think about freelancers, gig workers,
Yeah.
people with variable income.
Yeah.
For them, an emergency fund isn't just nice to have, it's fundamental. It smooths out the lean months, keeps them stable.
Critical for that segment of the workforce.
Absolutely. But maybe the biggest benefit for everyone listening, peace of mind. Just knowing you have that cushion. It lowers financial stress enormously. You can focus on fixing the problem, not freaking out about paying for it. It protects your future.
Okay, totally sold on the why. Now, the big question. How much? How much do you actually need in that fund? Feels like the million-dollar question.
It is. The standard advice is usually 3 to 6 months worth of essential living expenses.
Okay, define essential very carefully here.
Right. Not discretionary spending. We mean rent or mortgage, utilities, food, transportation costs, insurance premiums, minimum debt payments.
The absolute must-pays.
The things you absolutely need to cover to keep your life functioning.
And you said 3 to 6 months. Why the range?
Because it's personal. It depends on your situation. How stable is your job or industry?
Okay.
Are you the sole earner in your household? Or are there multiple incomes? How high are your fixed monthly costs? Do you have kids?
Health issues. So it's a risk assessment, really.
Exactly. Someone single, secure job, low expenses, maybe 3 months feels okay. A freelancer with unpredictable income, or a family on one income, they should probably aim for 6 months.
Or maybe even more.
Some experts even suggest 9 or 12 months for highly variable situations. It depends on your comfort level and risk.
So the process is figure out your essential monthly burn rate, then multiply by the number of months that fits your personal risk profile.
That's the strategic way to set your target.
All right. Got the target number. Where do you keep this cash? Not stuffed under the mattress, right?
Please.
Oh.
No. You need it safe, but also easily accessible. Like really easily accessible.
Okay.
The ideal place is usually a high-yield savings account.
High-yield savings. Why specifically that?
Couple of reasons. One, keep it separate from your checking account. Out of sight, out of mind, reduces temptation.
Good point. Avoids accidental spending.
2, a high-yield account earns a bit more interest than a standard savings account. Won't make you rich, but helps it keep pace with inflation somewhat.
Okay. And accessibility.
That's the most critical part. It has to be liquid, available quickly. This is not investment money.
So no stocks, bonds, CDs.
Absolutely not. Don't tie it up where it could lose value or take time to access. You need to be able to get that money within a day or two max.
Got it. Safe, separate, liquid, maybe earns a tiny bit of interest. High-yield savings it is.
Generally the best bet, yes.
Okay, so for someone listening who's maybe starting from zero, building that fund 3 or 6 months of expenses sounds like a mountain. How do you make it doable?
It can feel daunting, for sure. The key is breaking it down into steps. Step 1. Set a small first target.
Right.
Don't stare at the final number. Aim for, say, $500 first, or maybe $1,000. Just getting that first win builds huge momentum.
Small victories, I like it.
Step 2. Automate it. This is probably the most powerful trick.
How so?
Set up an automatic transfer from your checking account to your emergency savings account every single payday.
Even if it's small.
Even if it's just $20 or $50 to start. Treat it like a bill. Pay yourself first. It just happens.
Out of sight, out of mind, gets the money moving before you miss it.
Exactly. Step 3. Trim the fat. Look closely at your spending. Unused subscriptions. Too much takeout. Find areas to cut back, even slightly.
And redirect that money.
Redirect it straight into the emergency fund. Turn those small cuts into savings fuel.
Leveraging those micro savings. Nice.
Precisely. And step 4. Use windfalls wisely. Tax refund. Work bonus. Unexpected cash gift.
Don't just blow it.
Resist the urge. Funnel a good chunk, maybe even all of it if you can, straight into the fund until you hit your goal.
Okay. Mini target, automate, trim, use windfalls. That feels much more manageable.
It really is. Consistency is everything.
Yeah.
Those small amounts add up faster than you think.
Love it. Now, just like with APR, are there common mistakes people make with emergency funds? Tracks to avoid?
Oh, definitely. A big one is undersaving. Hitting that initial $1,000 goal and then just stopping.
Even if their real need is much higher.
Exactly. They don't reassess or keep going towards their actual 3 to 6 month target based on their life situation.
Okay, that's a big one. What else?
Using it for non-emergencies.
Yeah.
This takes discipline. That fund is not for vacations, gadgets, concert tickets.
It defeats the whole purpose.
Completely. You have to treat it as sacred. Protect it.
Keep it sacred. I like that. Any other pitfalls?
Yeah, mixing it with other savings. Don't just lump it into one big savings account. It's too easy to mentally borrow from it for other goals, or just lose track of how much is really set aside for emergencies versus, say, a house down payment. Keep it separate. Dedicated account.
Isolated and sacred. Got it.
And maybe the most common mistake, just delaying, starting.
I'll do it later syndrome.
Exactly. I don't earn enough now. I'll start when I get that raise. Things are too tight. But even $10 a week is infinitely better than zero. It builds the habit. It shows commitment. Those small amounts add up.
Yeah.
Seriously, don't wait for the perfect time. Start today.
That's powerful. Start now, even small. Consistency builds the fortress. Okay, let's tie this all together. Understanding AL finance options gives you more pathways. Key-coding APR lets you compare costs, like a pro, avoiding those hidden traps.
Absolutely.
And building that emergency fund, that's your resilience, your financial shock absorber.
It really is. When you put them together, these aren't just abstract financial ideas. They're practical tools. Tools for more freedom, more security, more confidence in your financial life.
Knowing how this stuff works, it puts you in the driver's seat, making informed choices, not just reacting.
Exactly. So here's something for you to think about as we wrap up this deep dive.
Okay.
Imagine really understanding your money flow, not just income, but how you borrow smartly when you need to, how you save effectively, how you prepare for the unexpected bumps. How much more confidently could you navigate life's twists and turns with that knowledge? What's only the very first small strategic step, something you could do even today based on what we've talked about? Just one thing to start building your own financial fortress.